G'day there, Wealth Press subscribers, viewers, traders, and investors. It's time for another Monday morning roundtable, and I'm joined, as usual, by Jeff Zananiri, Jeff Yasteen, Adam Sarhan, and Roger Scott. Gentlemen, welcome.
Everybody.
Thank you for having us.
Hi.
All right, Roger, today I'm going to start with you. Last week, the Fed launched a stimulus program that essentially commits them to buying $120 billion in a combination of $80 billion a month in treasuries and $40 billion a month in mortgage-backed securities. And we saw everything sort of rise on that news. NASDAQ closed at an all-time high on Wednesday, and gold is taking off again. And what is our net takeaway from that event, in your opinion?
I think there's a huge disconnect between the fundamentals right now and the technicals, and I think it's going to end up catching up with us in the very not so far term. I think the biggest takeaway from last week, in my opinion, of course, was the retail report and the jobless report. The retail report came out on Wednesday. It confirmed what I was thinking, that retail is slowing down tremendously. The Black Friday, Cyber Monday was not spectacular by any stretch of the imagination, and that and employment data is, we're now at the upper 800,000 level. We're going back into the territory which I was afraid of. And again, you got to think about all this with the fact that we are now in real danger zone here. We don't have any money coming from the Fed in terms of a $1,200 paycheck like we did in March, April, May of last year. I don't even remember when that happened. 2020 is like a big black hole in a way. But it's just so many things happen and so many twists and turns. But I'm seeing that healthy people are not going to get the vaccine for another 3 to 4 months, and I'm seeing us right now, last week, in going back to where we were, and this is really bothersome, and I think it's going to catch up to the market sooner than later.
Okay, Adam, what do you think is going to happen in the face of this new stimulus, in the face of these disappointing jobless and retail numbers, in the face of the pandemic?
Yeah, I mean, my thought is the elephant in the room in the market is the Fed. And the Fed has made it abundantly clear, especially with their last meeting and Jay Powell's press conference after, that they're going to keep rates near zero, if not at zero, effectively below zero, because they have the tremendous amount of liquidity, which is a fancy way or euphemism for saying money being injected into the system. They're doing everything in their power to stimulate both Main Street, but more importantly for them, Wall Street. Why? Because like Roger mentioned, there's a huge disconnect right now between Main Street and Wall Street. And you're seeing a recovery, but it's not, if you just look at the Wall Street, the stock market, you think everything's rosy and this is booming, roaring 20s and blah, blah, blah. But that's just not what's happening on Main Street. So right now, the Fed made it abundantly clear in 2020, Roger, with your black hole, one of the major shifts in policy came from the Fed when they shifted their 2% inflation target. In the old days, they used to say, okay, we want inflation at 2%. Then in 2020 and the COVID aftermath, they said, oh, no, we're going to use 2% as an average or a range, which basically means they can keep rates really low for as long as they want with no accountability. Remember, the Fed has a dual mandate, help unemployment stay relatively low and keep inflation near 2%. So what they did was basically take all the guardrails off and say, okay, we can print forever. And if the market goes down or when the market goes down, guess what? We're just going to print more. So right now, the market is reacting well to all of that easy money and aggressive dovish stance from the Fed. As long as that continues, I'm bullish on the market. I have to give the bulls the benefit of the doubt. But however, the big caveat there is, once that doesn't continue, with that disconnect between the Fed pumping money into the system and the market going up changes, that dynamic shifts, then all bullish bets are off the table, in my humble opinion, and we get a blow off top, kind of like 1999 into 2000 with a big, who knows what that may follow.
Okay, that's interesting. Jeff Z, what do you think is going to happen?
I like that blow off top. I'll start there. Blow off tops are incredibly difficult to trade. Everyone thinks that you get a bell rang and you have a nice, 2-week period where you can carefully remove the risk you don't want from your portfolio, that's anything but the case. What happens is you get this, think of a Porsche going 100 miles an hour down the street and then thrown into reverse and going 100 miles the other way. It's a shocking thing that sometimes results in complete catastrophe. And even the most sophisticated, most advanced, most trained traders have a hard time pivoting. So they don't ring a bell. You don't get a nice period of time where you can take your profits at a acceptable level. Things go into reverse quick. It's a lot easier to sell when people are buying than when they're selling. It's the same thing in housing. It's the same thing in everything. It's particularly true in the stock market. So I'm seeing froth. I'm seeing warning signs, not in everything, but that's what's leading the market. NASDAQ's back to leading. A lot of the big high flyers are still doing crazy stuff. A lot of the IPOs are doing crazy stuff. There's SPACs everywhere. I don't want to sound like, the sky, Chicken Little, that like the sky's going to fall, but I've been through too many of these cycles not to know what I'm looking at. And the big thing with Powell and with the Fed is that, yeah, they're supportive and they want 2%. But the big thing is that they don't care so much that there are bubbles happening because they look at it as a necessary evil to maintaining some sort of order to the economy, because it's all anyone can do. Like Congress passing some sort of a tangible deal that's actually going to have some effect is almost like slim to none, as Roger was saying earlier. So this guy saying, okay, we might get some bubbles and some Bitcoin. There might be some crazy SPACs. Maybe Robinhood is signing up people to trade IPOs that don't even have an elementary school degree, but it's okay. We're going to hold our nose. We're going to look the other way because it's all a necessary evil to keep everything from going to, you know what?
Sure. All right. And Jeff Yasteen, what's your take on all of this?
I don't think I can say it any better than Jeff, Adam, and Roger have said as well. I think we're in a bubble type environment. I'll call it a melt up because a melt up seems like a better word here because you don't know exactly, as everybody's been saying before me, you don't know when these things are going to end. And we could be having this conversation 2 and 3 months from now and still looking for a top. I mean, good to go back to the 1999 2000 analogy, which I think is a good one. And I think the key here is by the time we do get to a top, we'll see so much volatility beyond what we've seen already that we'll still probably, for a lot of people, won't want to believe that it's really there and that it is the top. And I spent some time in recent weeks looking back at the run up to the end of the .com bubble in 2000, March of 2000. And it was interesting because 1999 from October to December, very little volatility, to the downside. It was just a clean move up. Then come January, there was a big, almost immediately, like January, whatever the first trading session of the year was, January 3rd, I think. There was like a 10, 15% sell-off in the NASDAQ, similar move in the Russell. And you would have thought, okay, maybe that's it. And yet it plowed higher, came back, retraced that same amount almost exactly again. And from there rose another 40% over the next 6-7 weeks and through mid-March. So that shows you like the level of volatility. And you think about that, we could sell off, say the beginning of the new year as institutional traders come in and sort of, take their profits and clear their books. And we could go down 15% and still be, in a bullish trend, which just shows you how much you have to sort of respect this, but at the same time, keep an eye out for the idea that, the end could be coming.
So on the one hand, then, are we to be thinking in terms of preparing for the worst in the beginning of 2021 and ignoring this exuberant sort of data coming out of the market because of all of the stimulus that's happening? Or should we be kind of like sit on the fence and wait and see how the year starts and then make plans? Where should we begin, Roger?
Well, that's a wonderful question. And what I'm really concerned about, and I'll tell you and I'll kind of narrow my focus because I'm not all doom and gloomy. I think the market has a lot more upside, specifically because of all the reasons Adam mentioned with the Fed. There's just too much money coming into the market. But where the danger zone for me lies is really ultimately the next 3 to 4 months. And I've been saying that all along because I feel I keep giving this scenario over and over again. It's like a James Bond movie, and you have the madman with the missile control here, and you have James Bond trying to save the day. And I've probably seen too many James Bond movies. And it's a matter of who can get, it's does James Bond dismantle the bomb, or does the madman press the button? And that's how I feel about the next 3 months. See, I'm very focused because here's my thinking. My doctors, the people in the broad medical society will tell you that healthy people are not going to get this vaccine in America for at least till April, May, March even. Where does that leave us right now? When I say right now, I mean in the current time period with the spike in COVID and without any clarity from the government if we're going to get that $600 or $1,200 paycheck. That's the problem. See, I think if we can get past this hurdle, if we can get past the next 3 months, I think things are going to do okay. My big concern is that first quarter of 2021 is how are we going to survive? How are businesses going to stay open? How are people going to function when we're not going to have this medication? And remember, the people who are healthy are those that are contributing to the workplace. The people who have all the conditions are not to begin with. So it's kind of like a catch-22. So I have this picture in my head. Is it going to be the bomb, or is it going to be James Bond saving the day? And I know it sounds cartoonish and outlandish, but really that's kind of what I'm thinking. So ultimately, I think the year is going to do just fine. But based on the technicals being really stretched out and based on the fundamentals giving us major warning signs, I think we may have some hiccups over the next 12 weeks or 14 weeks, if you will. Don't quote me on the exact date, but over the next quarter, because of the rate that we are seeing this influx of COVID again. What I'm afraid of ultimately is us Biden coming into the White House saying, America, we're closing down for the next 100 days or till we're not seeing a rise. It could happen. And where does that leave us? So my main concern really ultimately is that first quarter of 2021. If we can get past it, I think we're scot-free. We may not see 41% or 48% return out of NASDAQ next year, but I think we'll have a good year. I'm really concerned about the first quarter for all of the reasons I just stated.
Okay, great. Adam?
Sure. So I'm bullish for 2021. If we're shifting the focus on the future for next year, there's no question in my mind's eye, because you've got two major bazookas, if you will. You've got monetary policy, which is extremely dovish, and then you've got fiscal policy, which is extremely accretive for Main Street as well. So until we see any signs of selling, there's no question in my mind that we're going much higher. Now, I do want to note, and this has to be really, front and center, that we're getting closer to the end of a move up than we are to the beginning. And we've been rallying essentially since 2009. Most bull markets last 5 years, 7 years, or long ones, maybe a decade. Sure, you had a bear market in COVID in March of 2020 that lasted 2 weeks, but to me, that's not enough to really reset the clock, so to speak. So I'm of the mindset we're entering that bullish, frothy 1999, 1929-esque type environment where investors are throwing caution at the wind. Jeff had mentioned the IPOs that are just gone bonkers. Roger mentioned all of the stats. Look at the Russell. Since March of 2020 until the end of 2020, the Russell has essentially doubled. And that's not a normal move in a really less than 1 year period, in 3 quarters. So we're getting froth. Like James, you mentioned the put call ratios are going through the roof. Everyone's buying calls. Nobody's buying puts. You don't see these kind of things happening at the bottom. Now, I'm not saying we're at the top, because you get, these frothy markets can get a lot more overbought before the end of the move actually happens. So for me, I'm still very bullish because we have that massive two-front monetary and fiscal, tailwind, if you will, pushing the markets much, much higher. Now, just a side story here. Everyone knows JFK, right? JFK's father, Joe Kennedy. Does anybody know how he made his money?
Yes, bootlegging,
right? Back in Prohibition. And then afterwards, when Prohibition ended, he made a truckload of money in the stock market. And then in 1929, he was getting his shoe shine. This is the story. And the shoe shiner was bragging about how much money he was making and asking for stock tips, so on and so forth. And at his time, in his era, that was his way of saying, wow, its froth is way, 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 way out there off the deep end. So he covered his long, supposedly, and he went short. And he shorted the market and made a truckload during the 1929 and early 30 crash. And then he became one of the founding people of the SEC and all that kind of fun stuff because the government asked him to help and blah, blah, blah. And that cemented his generational wealth. But that frothiness that he noticed in that shoe shiner was equivalent to 1999. You saw the taxi drivers with the Quotrons back then because there was no smartphones back then. And they're trading stocks in their cabs. Or today you see this happens everywhere. So you really have to be mindful of where sentiment is on the spectrum from risk averse, to risk on to risk off, just to keep it simple. And you really have to ask yourself, where are we in the cycle? Are we early or are we late? That said, I'm of the mindset 2021 will be a very bullish year with corrections along the way, but be mindful of that big blow off top that really would signal, okay, now it's just gone way off the deep end.
Okay. I'm going to then redirect it to you, Jeff, but I want to point out that the unprecedented stimulus that equates directly to a liquidity load on the valuation, the upward valuation momentum of all asset classes in the markets globally, as a result of this unprecedented stimulus continuously, is got to be to some degree driving this incredible term of this bull market. And so when I look at that, I say, well, that's unprecedented. So therefore, the idea of cyclicality has to be adjusted to accommodate for this unprecedented liquidity load deriving from absolutely nowhere, just from the Fed going like this, woohoo, more money for the market. So Jeff Z, what is like, how do we figure that into it? Is it not conceivable that the government can just say, you know what, it's 1.4 trillion right now, but we're going to take it to 2.6 trillion a month in January 2022. So don't even think about selling and blow off top. Does that mean just like a profit-taking event because everybody's made money, or does that mean a major correction because the valuations have gotten out of control? Like, it's
so
just, to me, my head's just going like this.
That's the $1 trillion question. That's not even the $1 million question.
Right.
And I think the answer lies, I'll start at the top. The answer is going to lie in credit. You're going to see the first cracks if it's going to be a regime shift to financial crisis in credit. You're going to see high yield start to blow out. Right now, high yield is suppressed, and that's largely due to the fact that not only is the Fed keeping rates at zero, but they're an active buyer in corporate paper markets, which is also an unprecedented event. But the big thing about blow off tops and about this new reality, right? This new normal is that though this is a new normal and a new reality, and listen, as long as there's negative yielding bonds, people are going to own stocks. They're going to, I've got, you don't see it, but I've got a hole in the backyard with cash in it. Like, people are doing everything and buying everything. Like I said it, I think a few weeks ago, try to buy a Rolex right now. Try to get some wood to do your deck. Try to get a new refrigerator. People are clamoring for stuff because they have money. There's nothing to do. There's nothing to get yield in. So that stays the same. But one thing that I know to be universally true is that euphoria and bubbles always have tearful endings. There's never been a financial bubble that was like this iron dome that didn't burst violently at some point. I don't know how far it goes and how far it doesn't go and when it starts and when it stops, but there's a wiser man than me that made a shit ton more money than I have, named George Soros. I don't like his politics, but he's an excellent trader. And in a book that I read that he wrote, he said, when I identify a bubble, the first thing I do is I go long the bubble in small size. That does two things. Bubbles tend to go a lot farther than you expect them to, so I'm making money. And when the burst starts, because I'm already invested in it and I'm following it really closely, then I can get short size. And so I take that philosophy. The amateur hour would be like, let me short this bubble because I found this bubble. That's incredibly dangerous. The professional is carefully going with it, anticipating there will be a point in time when they will flip everything and go size against it.
Wow. All right. Jeff Yasteen, what's your vision tell you?
Yeah, I'll just add to what Jeff has said here as well, in that and it goes back to the idea of volatility. You could see right at the beginning of the year a lot of the froth on the NASDAQ side of things and tech come right off with just a sharp 15%, correction. And yet, at the same time, you still have all these other sectors within the economy. We've talked about them many times before with oil and banks and industrial stocks, which are certainly not rocket ships by any means, but they continue to sort of creep higher, and those could easily step in and pick up the pulling weight to still then on the next leg higher. Again, confounding most people, like, oh, I thought we had a 15% sell-off. I thought this thing was over with, and there goes the next leg to new highs. So it just speaks to what we're saying. I think you need to stay bullish because I think we are going to move higher, and at the same time, at least have some sense that you don't want to get too comfortable. You're going to have to take exits, or just take exits as as you get some nice profits on your positions, depending on whether you're investing or speculating, options or stocks. Just don't hold out for the last dollar, because you're not going to get it.
Okay, great. Finally, Roger, then can you give us a specific pick for the beginning of 2021?
A specific pick, huh?
Just to go and in the context of, as Jeff Z was saying, going small with the bubble and getting ready to go size on the reversal.
The two stocks. Well, you want one stock. I like Meli, MELI, because I think a lot of money is moving out of America right now. Global markets are expanding, and I think global e-commerce is going to pick up and ultimately prevail second half of 2021. So it may be a little rough ride, but I think Meli still has a lot more upside to go. When I picked that stock when it was about $400 cheaper than it is right now, and I think it's going to do tremendously well in 2021.
Okay, Meli. What is it exactly?
It's a Latin America e-commerce site. It's kind of like Amazon for South America.
Oh, interesting. All right, Adam.
Sure. My one stock, if I had to pick one stock, it would be Lululemon. And the reason why is because retail has been coming back, despite everyone saying it's not coming back. The XRT, which is an ETF that tracks retail stocks, since the March low has soared, and this is just retail stocks, from $26 to $63. It's tripled. And Lululemon itself has had a huge move. The reason why Lululemon is my favorite retailer of the group, it's because of the fact that they're in the athleisure space. So leisure is still going to be there, in my opinion, like Roger mentioned earlier in the show, until the vaccines come back. And we're still, quote unquote, in this quasi work from home / maybe get back a little bit to normal. We don't know how long the vaccine rollout will be, but the leisure wear is something that's going to be there for the foreseeable future. And Lululemon is best of breed, in my opinion, in that space. And for that reason, I think the stock's going much higher.
All right, Jeff Z.
Picks. I'll give you the bubble play, which is DraftKings. Cuomo came out yesterday and said that he loves sports betting now. It's gonna fill the hole that they have in their budget. Guess what, guys? You want free money? Somebody's got to pay for it. So they're looking at cannabis stocks. They're looking at sports betting. So you're seeing Penn National. You're seeing DraftKings. I prefer DraftKings. Not quite as frothy as Penn has become, and I think that can go a lot farther. And if you want a little bit of a less bubbly type of sector, I would go with the home building ETF, ticker symbol XHB. And I think the housing boom is going to be, I think the story of 2021, besides the crazy correction that we might most likely will see. I'm not saying it ends that way, but I'm saying you'll see one at least. Besides the correction we're going to see, I think the story is going to be real estate on steroids. I think you're in the beginning of a real estate bubble. You're at the end stages of a stock bubble. And so it kind of played out the same way in the early 2000s. Greenspan shifted the attention after 9/11 from stocks to housing. We got crazy real estate appreciation in the United States. You saw Florida go up 300, 400%. I know because I was chasing houses at that point in time. I stayed a little patient and I got a nice dip in 2008 to buy. But I think the same thing plays out. Money stays cheap, going to be everywhere. People are going to be a little bit helter-skelter on stocks, and they're going to go straight into housing, residential.
Interesting. Jeff Yasteen, what have you got in your quiver?
Yeah, one idea I like is that as these vaccines, are distributed and employed into the U.S. population, one thing that we're going to start seeing is a lot of the healthcare tech stocks and they're already starting to move higher in anticipation of this. Where frankly, for the most of the past year, there's a lot of doctors' practices and outpatient clinics and those sorts of things that basically have had no customers. And so for a lot of these healthcare tech companies, they haven't been able to either generate revenue from the use of their products or to sell new products into that base of customers. So as we see the vaccines progress, we're going to see that part of the healthcare industry start to pick up. And I'm already seeing like there's one stock I really like for the coming year, ICU Medical, ICUI. There's another one called ICAD, that is basically in a similar part of the industry. And those kinds of stocks will all do well, I think, as we basically see this warming up. And they haven't really moved that much over the past 9 months, for obvious reasons. They're still rather depressed compared to the rest of the tech world, if you will.
You bet. All right, gentlemen, that was a great roundtable. I really appreciate your input as per usual, and I look forward to speaking to you all further down the road. Have a very Merry Christmas for those who celebrate it, and we'll see you all next year. Thank you for joining us.